So what are the benefits of high cash value life insurance? Stick around and I'll tell you the top 5 so you can see if it's right for you and teach you, if you hang in to the end, the double dip effect that allows you to make your money in 2 places at the same time. All right, so number 1 benefit of having this kind of policy, especially if it's high cash value, is less fees. The only reason you have high cash value is because there's less fees. Now, someone might say, well, I'm putting in more money. I could do that. Yes, you can. But why do we want to put in more to have to work harder to get that? The best way to do it, really the real secret, it's not about the big dividend rates of different companies and all that. That's smokescreen. That's all sales stuff from insurance agents. Which company's better, blah, 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 right? Really what it comes down to is which company and which policy allows me to have the least fees necessary to allow me to put in X amount of dollars per year. That's the secret, nothing else. I've actually seen insurance companies, in fact, that said, hey, we'll pay you a 1% dividend rate, but they'll have less fees than the company paying 7%. And still beat them. Again, it always comes back to the fees. All the smoke screen about dividends doesn't really matter as much. All things being equal, of course we want more dividends. But what it really comes down to is how do you get the least amount of fees coming out so it allows your cash value to grow faster? That's number 1 important. Number 2, we want more cash now, right? More savings, more money to invest. This is, I think, something that many people forget or miss, especially people that are infinite bankers, the insurance agents that are trying to sell it to you. They'll always sell it to you as something like, hey, this is down the road. You know, when you get to retirement, this is a supplemental retirement fund is what they'll say, you know, retirement savings. And so they push it off as this long-term thing. But what about now? How does it benefit your life today? Most people don't realize if you get high cash value life insurance, this works much better. Now, understand, I was an insurance agent even as a financial advisor. I thought whole life was the biggest waste of money ever. And then I met real estate investors that were raving about whole life insurance. I thought, wait, this can't be right because I can buy universal life policies and we can invest in stock markets and stuff and make more money. This whole life is so boring. Why would you guys do this? Well, they said, well, it's because we can have this money and use it to invest and do other things that you can't always do with the universal life policy. I said, okay, I'll bite. Well, I bought my first policy through that insurance agent. Now, he put higher fees on it. And he just said, listen, there's higher fees up front, and that's true. Whole life insurance is more front loaded on the fees in the first 2 years especially. But he says, but down the road, 5 or 10 years, you can use this to finance cars, houses, you can do all kinds of stuff. So you just have to hang in there long enough. But this infinite banking thing is awesome. So he was the one that taught me infinite banking, but it wasn't max ROI infinite banking. Because I remember I asked him point blank, I said, listen, I understand what I could do with universal life. Are there ways to adjust this so I can make more in cash value in this policy? His answer was, no, you cannot. Well, you can imagine my shock and my surprise when I found out later that he was lying. 100% lie. Now, he did say, yes, the truth was that the way he designed it, I couldn't put in more money. That was true. But he could have designed it up front to have less cost and allow me to put in more money, allowing that cash to grow faster. When I had a little debate with him, I went 2 hours debating with him back and forth about why you should have more cash now versus later. And I even talked about death benefit. I even matched his death benefit and everything. It really came down to one thing. He finally just said, Chris, I can't afford to cut my commissions. And I said, there's the truth. And that's the reason I will never, ever send you a referral because I can't trust you. You're money motivated for you, not for the client. By the way, as of today, this guy is out of the business. He's not even in the business anymore, okay? That's the reason. We want to have more money to invest today. Because the biggest argument that most of us as investors have is, well, I'm putting all this money in and finally have money down the road, but I could have used that money now to invest and make more. So why not just buy term, invest the difference? Well, here's why. I could actually go and have money today. I can have my cake and eat it too, have more money in there, use most of that money I'm putting in, and immediately go and invest it as well, making more money than I ever would, just letting it sit there growing at 4, 5+% a year. That's the truth. So I can go and make money right now. Love it for that reason alone. Now, another reason that's really good is because you have more options. It can be a great emergency fund. It could be a great place to just store money, or maybe an opportunity fund for future investments. Maybe you're kind of holding on right now. You're not sure what's going on with the economy. You're not really sure where to invest. Great place to store money and at least make some money on it tax-free versus 0.nothing% in your savings account that then taxes you on 0.nothing%. So I actually keep it for opportunities and I keep it for emergencies. I remember my wife, she said, Chris, I want to have $250,000 sitting in savings that you can't touch, no investing. I said, well, $250,000 sitting at earning 0.05% in a savings account makes us, well, I don't know the math, but hardly anything, right? Makes us almost nothing at 0.05% in the bank. But I said, what if we diversified the savings a little bit? What if we kept 200,000 of that 250,000 in the life insurance that earns about 5% tax-free, and then the other 50,000 stays in the account? Do the math. 5% on 200,000, I'm making $10,000 more a year than I would in that stupid savings account. And it's tax-free, and it's protected from lawsuits and creditors. So even if something bad happens, that money's protected. It's there in case I need it. So another great reason why I like to use high cash value life insurance, because more of it can go into emergency savings faster. In fact, many of our clients, the first year or two, they just use their emergency fund to fund it. They don't even use the extra savings that they have. They just use that to diversify their emergency savings account. This is one I don't always talk about, is the death benefit. There is a death benefit to it. In addition to everything else that makes this a great tax-free supercharged savings account, there's also a death benefit. Many people say, well, term insurance is cheaper, which is true, it is, at least today. But understand that term insurance gets more expensive over time, and eventually, if you keep trying to renew that term insurance, you will pay for your entire death benefit by the time you're in your late 70s. So what's the purpose of that? To basically pay for your own death benefit, you might as well just store cash, right? But with whole life, the great thing is that it can pay for itself within a few years, and usually after year 5 or so, you have just as much, if not more money than what you paid into it. So you actually get a bigger benefit than just buying term insurance. So you get the death benefit and you get cash value that you can leverage today. It's a living and a death benefit. But here's the number one living benefit that I love. And I mentioned this, it's the double dip effect. How can you make money in 2 places at the same time? See, now you can just go and withdraw money out of this account and go and invest it, which is great. But the thing is, when you pull any money out of any kind of savings account, now that money over here goes down, doesn't it? You're earning less interest over here. Yes, you're making money here, but the interest goes down, because if you had $100,000, you pull out 50, now 50,000 is earning interest instead of 100. But what if, and this is, I'm saying what if, but really this is what you can do, you can actually get a line of credit against it, whether it be through the bank or the life insurance company. You are able to borrow money from them because they know this is guaranteed. Money doesn't ever go down in life insurance. The cash value is guaranteed to earn at least 3-4% a year, right? So they know that money's guaranteed. They'll give you a loan with that as collateral, just like a home equity line of credit, but this is your equity. So they give you a loan from their pocket. Your money's still all in there. So the 100,000 is all in there, earning tax-free compounding interest, and you can take that 50,000 and go and invest it. Now, people say, why would I pay for my own money? Here's the reason why. Because the money they lend you, if you're doing it right, will be less interest that you're being charged than what you're making over here. So you'll make more money over here while also investing. Therefore, you make interest in your life insurance and you're making money on that investment. You make money in 2 places at the same time. Now, granted, we have all kinds of videos about how that works, but just know that that's a huge benefit right there. If you got nothing else, that for me makes this a no-brainer. Okay, so if you thought this was an awesome strategy and this is good stuff, check out how to achieve financial independence and retire early, and you don't even have to use infinite banking. So check that out now.